Hello students, welcome to the lecture on production, cost and revenue, and after this lecture we will be able to learn the following objectives. Explain production, total product, average product and marginal product. Understand the concept of cost. Discuss on short run costs, define the term revenue and explain producer's equilibrium. Let us begin our lecture starting with production. Production is a process through which a firm transforms inputs into outputs. A main focus of economic study is the production and its factors which represent items individuals and businesses use to create valuable products desired by consumers. Some features of production are: production is considered technically efficient method of production if the production process can produce maximum output from given combination of inputs. A firm is economically efficient when it produces a given amount of output at the lowest possible cost for a combination of inputs provided that the prices of inputs are given. A production process can be called efficient if another process produces the same level of output using one or more inputs, other things remaining constant. However, if a production process uses less of some inputs and more of others, the economically efficient method of producing a given level of output depends on the prices of inputs. Another important distinction that should be clear is about the division of the inputs into two categories, that is, a fixed input. Fixed input is one whose quantity cannot be varied during the time under consideration. Inputs that are classified as fixed inputs include plant and equipment of the firm. Variable inputs. On the other hand, a variable input is one whose amount can be changed during the relevant period. For example, in the construction business, the number of workers can be increased or decreased on short notice. In the above discussion, we talked about relevant time periods. What is a relevant time period? It is important to highlight that economic time periods are different from calendar or accountancy time periods. Different types of economics time periods are: the short run is defined to be that period of time when some of the firm's inputs are fixed. Since it is most difficult to change plant and equipment among all inputs, the short run is generally accepted as the time interval over which the firm's plant and equipment remain fixed. The long run is that period over which all the firm's inputs are variable. In other words, the firm has the flexibility to adjust or change its environment. Factors of production in economics. Now I will introduce you to various factors in production, which are as follows. Land. Land represents the physical assets or resources in the economic marketplace. This factor of production is often seen as a passive or fixed economic resource. Labor. Labor represents the human effort needed to transform physical resources into consumer products. Workers are usually compensated for their services through wages and salaries. Capital. Capital represents the monetary or physical items used to produce goods or services. Monetary capital represents the money companies use to purchase physical assets or pay workers for transforming assets into consumer products. Capital also includes buildings, production facilities, equipment, technology, and other tangible items. Entrepreneurship. Entrepreneurship is sometimes considered a factor of production, as individuals usually having ideas and attempt to make an economic profit from their idea using the factors of production. The entrepreneur also carries most, if not all, risks associated with turning his idea into a lucrative business. Total product, average product, and marginal product. Production by a firm can be classified as total product, average product, marginal product, total product. The factors of production are combined to make goods and service. The value of total production by using all factors of production is known as total product or total output. The total quantity of output produced by a firm for a given quantity of inputs is termed as the total product. The total product curve is a graphical representation of the relation between the total product and the variable input. The overall slope of this curve is positive, with extra workers generally leading to greater production. However, the curve has a distinctive shape, emerging steeply from the origin, then flattening and eventually declining. The shape of this curve is attributable to the law of diminishing marginal returns. Average product. Average product is defined as the output per unit of variable input. We calculate it as total product upon number of units employed. The average product curve is a graphical representation of the relation between average product and the variable input. The general slope of this curve is negative, with per unit output lower for larger workforces. However, the average product curve is actually hump-shaped, with a positive slope giving way to negative slope. Marginal product. Marginal product is defined as the change in total product that comes as a result of a 1 unit increase in the variable input capital level of a firm. Continuous marginal product is calculated as a derivative of total product with respect to the variable input employed. You can calculate marginal product by dividing the change in the total product by the change in the variable input. Concept of cost. This section will help you understand the concept of cost. Let's start with the definition of cost. The term cost is a frequently used word that reflects a monetary measure of the resources sacrificed or foregone to achieve a specific objective, such as acquiring a good or service. The important point is that cost is rarely used without considering the type of that. There are two types of costs. Direct costs. Those costs that can be specifically and exclusively identified with a particular cost object. Indirect costs. Those costs that cannot be identified specifically and exclusively with a given cost object. As an example, we can mention the salaries of factory supervisors or the rent of the factory. Costs can be further distinguished into several categories as replacement and historical costs. The historical cost of an asset refers to the actual cost incurred at the time the asset was acquired. In contrast, the replacement cost stands for the cost which must be incurred if the asset is to be purchased today. The two concepts differ due to price variations over time. Explicit costs and implicit costs. Explicit cost is a business expense accounted cost that can be easily identified, such as wage, rent, and materials. Explicit costs gives clear and evident cash outflows from business that decreases its end result profitability. Implicit costs are the imputed cost of using factors of production that a firm owns. For example, if an owner uses his own property as a factory building, then the rent of that building is implicit cost. Real costs and opportunity costs. Real cost can be explained as the money spent in buying goods or services. For example, if I pay a plumber $2 for repairs, then $2 is my real cost. Opportunity cost. Opportunity cost can be explained with the help of an example. If we spend 3 hours repairing the ruptured pipe, that is 3 hours that we are not doing something else like working for my clients or spending time with family. The things that we give up by not choosing them are the opportunity costs. Short run costs. In this section, I will introduce you to the various kinds of costs in the short run. Total cost. Total cost is the overall opportunity cost incurred by a firm in production. For short run production, total cost consists of variable cost, which depends on the quantity produced, and fixed cost, which does not vary with production. Total fixed cost. Cost of production that does not change with changes in the quantity of output produced by a firm in the short run is total fixed cost. At any and all levels of output, fixed cost is the same. Fixed cost is incurred whether or not any output is produced. Total variable cost. Variable costs are corporate expenses that vary in direct proportion to the quantity of output. Variable costs are a direct function of production volume, rising whenever production expands and falling whenever it contracts. Examples of common variable costs include raw materials, packaging, and labor directly involved in a company's manufacturing process. Average fixed cost. Average fixed cost refers to fixed cost per unit of output. Average fixed cost is found out by dividing the total fixed cost by the corresponding output. The average fixed cost begins to fall with the increase in the number of units produced. The average fixed cost diminishes with every increase in the quantity of output produced, but it never becomes zero. Average variable cost. Average variable cost refers to the variable expenses per unit of output. Average variable cost is obtained by dividing the total variable cost by the total output. When a firm increases its output, the average variable cost decreases in the beginning, reaches a minimum, and then increases. So the AVC begins to decrease. When the plant works to its full capacity, the AVC is at its minimum. If the production is pushed further from the plant capacity, then less efficient machinery and less efficient labor may have to be employed. This results in the rise of AVC. Marginal cost. Marginal cost is the addition to the total cost by producing one more units of output. It is the difference between the previous total cost and the present total cost. It is the addition to the total cost of producing n units of output instead of n minus 1 units. In symbols, man is equal to TCN minus TCN minus 1. Marginal cost changes due to the change in variable costs. It has therefore no relation with the fixed cost which is given and constant. After studying about all types of costs, now we will try to learn about the relationship between them. The relationship between total cost, total fixed cost, and total variable cost are as follows. TC is the sum total of TFC plus TVC. Only total variable cost changes to total cost because total fixed cost always remains fixed and never increase and decrease with the change in level of output. Relationship between AC, AFC and AVC. Average cost is the sum total of average fixed cost and average variable cost. AC is equal to AFC plus AVC. The gap between AC and AVC comes closer and closer but never intersect each other because AC is equal to AFC plus AVC and AFC is continuously falling and never rises. Relationship between MC and AC. When MC decreases but positive, AC also decreases but MC is greater than AC. MC always cuts AC at its minimum point and here MC is equal to AC. When MC increases, then AC also increases but MC is greater than AC. Relationship between MC and AVC. When MC decreases, then AVC also decreases but MC is less than AVC. MC always cuts AVC at its minimum point and MC is equal to AVC. When MC increases, then AC also increases, but MC is greater than average variable cost. Marginal cost, average variable costs are in U shape because of the inverse relationship cost and production. It means production increases then cost decreases, and when production falls, then cost increase. We can summarize the relation between them. Total fixed cost remains fixed irrespective of increase or decrease in production of activity. The total variable cost increases proportionately with production. Here the rate of increase is not constant. The total cost increases with volume of production. The average fixed cost per unit decreases as the volume of production increases. Whenever production increases, the fixed costs are shared to a greater number of units, thus fixed cost of unit variable declines. The average total cost decreases up to a certain level of production. After this level, it rises slowly. If this is represented graphically, it results in a flat U-shaped curve. The lowest point of the average total cost curve denotes the ideal level of production. Marginal cost is the change in total cost resulting from unit change in output. The marginal cost also decreases up to a certain level of production. Later, it raises slowly. Benefits of cost-output relationship are formulating the standards of operations, formulating the rational policy on plant size, formulating a policy of profit prediction, formulating a policy of pricing fixation, formulating a policy of promotion methods, formulating a policy of expenses control. Revenue. After studying cost, the next most important component under economics is revenue. Revenue is a measure of how much money a company has brought in within a given period. Total revenue. The total revenue can be termed as firm's income received from the sale of a given level of output. It is calculated as the price of the good multiplied by the quantity sold. Marginal revenue MR. It is the revenue received from selling one more unit of output. If the firm's decision to sell output will not impact the price of output in the market, that is competitive market, the marginal revenue is equal to the per unit price of the output. MR is equal to PY. The firm's objective is to maximize the difference between revenues and costs or economic profit. Economic profit, sometimes called economic rent, is calculated as total revenue minus total cost is equal to TR minus TC. Conceptually, a firm will continue to increase production as long as the cost of producing one more unit of output is less than or equal to the revenue the firm receives from the sale of that unit. Thus, the profit maximizing output rule can be stated as MR is greater than MC. Average revenue. The average revenue is the total revenue divided by the level of output. It is therefore the price. Average revenue is revenue per product. Producers' equilibrium. We studied the concepts of costs and revenue to understand the concept of producer equilibrium. Producer's equilibrium refers to the level of output of a commodity that gives the maximum profit to the producer of that commodity. Profit equals total revenue less total cost. Therefore, the output level at which total revenue fewer total cost is maximum is called the equilibrium output level. There are two approaches to achieve producer equilibrium: total revenue less total cost or TR minus TC. According to this approach, there are two conditions of producer's equilibrium. TR less TC is maximum and profits fall if one more unit of output is produced. MC is equal to MR approach. According to this approach, there are two conditions of producer's equilibrium. MC is equal to MR. MC is greater than MR after the MC is equal to MR output level. The following two conditions are necessary for a firm to be in equilibrium. The marginal revenue should be equal to marginal cost. The marginal cost curve should cut marginal revenue curve from below. Short run equilibrium. I hope you understood this concept that I just explained. Now we will move further and study about short run equilibrium. The equilibrium in the short run is shown by the intersection of the aggregate demand AD curve and the short run aggregate supply SAS curve. When either AD or SAS shifts, the equilibrium point is changed. For example, a shift to the right of the AD curve will cause the equilibrium output as well as the price level to increase. And if the AD curve were to shift to the left, the opposite would be true. Output and price level will decrease. Long run equilibrium. Like short run equilibrium, long run equilibrium can also be determined. The equilibrium in the long run is shown by the intersection of the AD curve, the SAS curve and the long run aggregate supply LAS curve. Since LAS represents potential output, a shift in the AD curve will only result in a change in price level. A shift to the right increasing price level and a shift to the left decreasing price level. Summary. Now in the end, let us summarize what we have learnt in this lecture. Production is a process through which a firm transforms inputs into outputs. In short run, only variable factors can be changed, whereas in long run, both variable and fixed factors can be changed. Costs are the expenses incurred for producing output. Total cost is equal to total variable cost plus total fixed cost. Total average cost is equal to average variable cost plus average fixed cost. When MC increases, then AC also increases, but MC is greater than AC. The total revenue can be termed as firm's income received from the sale of a given level of output. It is calculated as the price of the good multiplied by the quantity sold. MC is equal to MR approach. According to this approach, there are two conditions of producer's equilibrium. MC is equal to MR. MC is greater than MR after the MC is equal to MR output level.